New York City, early 1907. At first glance, everything looks perfect. The streets are alive. Factories roar day and night. Steel, oil, railroads. America is building faster than ever before. Skyscrapers rise into the sky like monuments to progress. Fortunes are made overnight. Newspapers celebrate a new age of prosperity. This is the United States at the peak of an economic boom. Money is everywhere, or at least it seems to be. Banks are opening on every corner. From the grand institutions of Wall Street to small-town banks and farming communities, they all promise the same thing: safety, stability, trust. People deposit their life savings without hesitation. After all, banks have always been there. They've survived wars, recessions, and decades of change. What could possibly go wrong? But beneath this image of confidence lies something far more fragile. America's financial system looks solid on the surface, yet it is quietly stretched to its limits. Most banks hold only a fraction of the money they promise to return. The rest is lent out, invested, speculated on, always chasing higher returns. As long as people believe the system is safe, it works. Trust is the foundation. Confidence is the glue. And confidence, once broken, is almost impossible to restore. Very few people understand how close the system already is to collapse. Fewer still realize that the fate of millions will soon depend not on laws, not on the government, but on the decisions of a handful of powerful men. Men driven by ambition, by ego, and by greed. In 1907, America does not yet have a central bank. There is no institution designed to step in during a crisis. No lender of last resort. When trouble comes, banks are expected to survive on their own, or fail. At this moment, no one is panicking. There are no crowds outside bank doors. No screaming headlines. No shattered windows. Just optimism, expansion, and the intoxicating belief that growth will never end. But history has a pattern. The most violent financial collapses rarely begin with fear. They begin with confidence. And in the fall of 1907, that confidence is about to evaporate faster than anyone imagines. Because all it takes is one spark. And once it appears, the panic will spread with terrifying speed, exposing the weakness of the entire system, and revealing a truth that will shock the nation. That the American economy is not protected by the government, but balanced on the will of a single man. To understand why the panic of 1907 was inevitable, we need to look behind the marble walls of America's banks. The system looked simple, honest even. People deposited money. Banks issued loans. Businesses grew. Everyone benefited. But this simplicity was an illusion. By 1907, nearly every American bank operated under the same rule: fractional reserves. For every dollar deposited, only a small portion was kept in cash. The rest was sent out into the economy, loaned to factories, railroads, speculators, and stock markets hungry for more capital. On paper, it worked beautifully. Money didn't sit idle. Moved. It multiplied. It created growth. But there was a dangerous assumption at the heart of the system, an assumption no one questioned: that not everyone would come back for their money at the same time. As long as depositors stayed calm, banks remained stable. Withdrawals were predictable. Reserves were enough. But banks were not built to survive fear. If trust disappeared, even briefly, the math stopped working. No bank, no matter how respected, could survive a mass withdrawal of deposits. Not because it was corrupt, but because the system itself was never designed for panic. And panic was exactly what speculation was feeding. Wall Street in the early 1900s was not a place of careful investing. It was a casino disguised as finance. Leverage was everywhere. Borrowed money fueled stock prices. Risk was normalized. Success bred overconfidence. Banks were no longer just guardians of savings. They were active participants in speculation, directly and indirectly funding risky bets with ordinary people's deposits. Few depositors understood this. They believed their money was safe behind thick vault doors. In reality, it was scattered across the country, tied to volatile markets, fragile businesses, and the personal ambitions of powerful men. There was no safety net. No federal deposit insurance. No central authority to inject liquidity. No mechanism to stop contagion once fear began to spread. If one major bank failed, suspicion would immediately fall on others. And once suspicion turned into panic, even healthy banks would collapse simply because people rushed to withdraw their money. It was a system built on confidence, and confidence alone. And confidence, as history repeatedly shows, is the most unstable asset of all. By the fall of 1907, America's financial system was stretched tight, like a wire pulled to its limit. All it needed was a single miscalculation, a reckless gamble, a sudden loss, a spark. That spark would come not from an economic slowdown, not from war, not from government policy, but from the greed of a few men who believed they could outsmart the market itself. And when their bet failed, it would expose the fragile truth beneath America's prosperity and unleash one of the most terrifying financial panics the nation had ever seen. Every financial panic needs a trigger. In 1907, that trigger was not a war, not a natural disaster, and not a government decision. It was greed. At the center of the coming storm stood a small group of men who believed the rules of finance did not apply to them. They had money. They had influence. And they were convinced that with enough capital, the market itself could be controlled. Their plan was bold, elegant, and fatally flawed. Speculation in early 20th century America was widespread, but this was different. This was not a cautious bet. It was an attempt to corner an entire market, to force prices to move in one direction and crush anyone standing in the way. The logic was simple: if you control supply, you control price. But markets are rarely simple. To execute the scheme, enormous sums of money were required, far more than any one individual could safely risk. And so the line between personal ambition and public trust was quietly crossed. Funds that did not belong to speculators were pulled into the gamble. Bank money. Depositors' money. The savings of ordinary people who had no idea their futures were being wagered on a single high-risk move. At first it worked. Prices surged. Confidence grew. On the surface it looked like a triumph. Those betting against the scheme began to panic, scrambling to cover their positions. For a brief moment, it seemed as if the market itself had been conquered. But then reality intervened. There were more shares than expected. More liquidity. More resistance. The market did not obey. Within hours the rise stalled. Then it reversed. Prices collapsed with shocking speed. What had looked like a brilliant financial maneuver instantly became a catastrophic miscalculation. Losses mounted. Positions unraveled. Firms connected to the scheme began to fail, not gradually but all at once. And with them disappeared millions of dollars. Money that could not be recovered. Money that had once been someone's life savings. At first the damage was contained. Or so it seemed. A few brokerage houses failed. A few insiders were ruined. On Wall Street this was not unheard of. Markets rise, markets fall. Fortunes vanish. But this time the losses were not isolated. They were tied directly to banks. And once the truth began to surface, once people started asking where that money came from, fear replaced confidence almost overnight. Which banks were exposed? Which institutions had funded the gamble? Who was next? These questions spread faster than facts ever could. Trust, once shaken, does not wait for answers. It runs. And as whispers turned into rumors and rumors turned into headlines, the spark finally touched the wire. The panic had not yet arrived. But it was no longer avoidable. Panic does not announce itself. It begins quietly. A few depositors show up at bank doors earlier than usual. They withdraw small amounts. Just in case. Clerks notice the change but say nothing. The system absorbs it. For now. Then the lines start to form. News spreads not through official statements but through whispers. Through headlines. Through conversations on street corners and factory floors. One bank is rumored to be in trouble. Then another. No proof. No confirmation. It doesn't matter. Fear does not require evidence. By the time banks attempt to reassure the public, it is already too late. Confidence has cracked, and once it cracks, it collapses. Crowds gather outside financial institutions across New York. Men clutch passbooks. Women beg tellers to hurry. Police are called to maintain order. Inside the banks, cash reserves drain at an alarming speed. What the public is witnessing is not fraud. It is arithmetic. Banks are paying out exactly what the system allows, until it doesn't. The vaults were never meant to satisfy everyone at once. Loans cannot be recalled overnight. Investments cannot be instantly liquidated. And so, one by one, banks suspend operations. Doors close. Notices go up. Silence replaces reassurance. Each closure accelerates the next. If that bank failed, why not this one? If they couldn't survive, who can? The panic spreads beyond those directly involved in the original speculation. Healthy banks fall simply because they are suspected. Innocent institutions are punished not for what they did, but for what people fear they might have done. Across the city, the same scenes repeat. Shouting, crying, anger, desperation. Businesses cannot access credit. Payrolls are missed. Factories shut their gates. Workers are dismissed by the thousands. The stock market collapses as investors sell whatever they can, desperate for liquidity. This is no longer a financial problem. It is a social one. Families lose their savings in days. Lifetimes of work vanish behind locked bank doors. Some cannot endure the shame or the fear. Tragedy follows collapse. And still the panic grows. Telegraph wires carry the news across the country. Other cities fall into the same rhythm of fear. Bank runs erupt simultaneously in multiple states. What began as a localized shock becomes a national emergency. The government attempts to intervene, but it has no real tools. There is no central bank to flood the system with liquidity. No authority strong enough to halt the contagion. Treasury funds are limited, symbolic against the scale of the collapse. For the first time, the nation confronts an uncomfortable reality. The American financial system is collapsing, and the government cannot stop it. By now, everyone understands what is at stake. If the panic continues, the entire economy will fail. And that is when the impossible happens. When desperation reaches its peak and faith in institutions is gone, the country turns not to the state, but to a single man. When the panic reaches its peak, the country runs out of options. Banks are failing faster than they can be saved. Markets are frozen. Trust is gone. And for the first time, the United States faces a terrifying truth. The government is powerless. There is no central bank. No emergency mechanism. No institution capable of stopping the collapse. And so, in an extraordinary moment in American history, the fate of the entire financial system shifts away from Washington and into the hands of one man. He is not elected. He does not hold public office. He answers to no voters. Yet he controls more capital than the federal government itself. J.P. Morgan. At this moment, Morgan is already a legend. Railroads, steel, finance, entire industries bend around his decisions. When markets listen, they listen to him. When banks need help, they come to his door. And now they come again. Late at night, the most powerful bankers in the country gather in Morgan's private library. The doors close behind them. No press. No public statements. No guarantees. Just men who understand that if this meeting fails, the system collapses by morning. Morgan does not panic. He does not rush. He listens. Then he speaks. The solution he proposes is brutal, but effective. Strong banks will survive. Weak ones will not. Liquidity will be provided, but only under strict conditions. Assets will be sold. Control will change hands. Stability will come at a price. Some protest. They accuse him of exploiting the crisis, of consolidating power, of using fear to expand his empire. Morgan is unmoved. Under these conditions, there is no alternative. Throughout the night, deals are made. Funds are pooled. Decisions are forced. By morning, a plan exists, not sanctioned by Congress, not approved by the president, but backed by the credibility of the most powerful financier in America. When the markets open, Morgan speaks publicly. His message is calm, confident, absolute. The banks will be supported. Liquidity will be available. The panic is over. And astonishingly, it works. Almost instantly, fear begins to retreat. Lines outside banks shrink. Depositors return cash. Markets stabilize. What weeks of chaos and government action could not stop is halted by a single statement from a single man. The country breathes again. J.P. Morgan is hailed as a savior. But beneath the relief lies a far more unsettling question. What does it mean when the survival of a nation depends not on its institutions, but on the goodwill of one private individual? The panic is over. Banks reopen. Markets recover. The lines disappear from the streets as quickly as they formed. To the outside world, it looks like a return to normal. But the damage is already done. Hundreds of banks never reopen. Millions of people lose their savings, not because they speculated but because they trusted the system. Factories remain closed for months. Unemployment surges. Families are ruined. The panic of 1907 leaves scars that will not fade easily. J.P. Morgan emerges as a national hero. Newspapers praise him as the man who saved America. Politicians thank him. The country celebrates stability restored. Yet behind the applause, a quieter, more disturbing realization takes hold. One private banker had more power than the United States government. When the Treasury was helpless, he acted. When institutions failed, he decided who survived. With a single statement, he stopped a nationwide collapse. It worked. And that was the problem. Because what if, next time, he chose not to act? What if his interests did not align with the public good? What if one man's judgment was wrong? The panic exposed a fundamental weakness at the heart of American capitalism. A system that depended on confidence, but had no authority to protect it. A nation whose financial stability rested not on law, but on personality. In the years that followed, debate turned into reform. Slowly, reluctantly, the country accepted a truth it had long resisted. A modern economy could not survive without a central bank. An institution powerful enough to act when markets froze. Strong enough to supply liquidity when fear took over. Independent of any single individual. In 1913, the Federal Reserve was born. Not because Americans wanted it, but because they feared the alternative. The panic of 1907 faded into history. But its lesson remained. Financial systems do not collapse because of one bad decision. They collapse because of structure. Because of incentives. Because of human behavior. And because, sooner or later, confidence breaks. If this story felt unsettling, it's because it should. The past is never as distant as it seems. Many of the forces that shaped 1907 still exist today. Leverage, speculation, concentration of power, and the fragile trust that holds everything together. History doesn't repeat itself exactly, but it rhymes. If you want to understand how financial power is built, abused, and reshaped by crisis, and why the past still matters more than we think, subscribe to Finance Archives. Because the next panic never looks like the last one. And the archives always remember.